Hey y'all, and welcome back to Getting Digital with Deisha. Mm, 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 mm. Mhm. Okay, you guys, so today we're going to be talking about the pattern day trading rule, PDT rule for short. And if you've ever traded stocks or stock options or anything like that, you know exactly what this is. So for those of you who don't know what this rule is, I'm going to tell you. So essentially it was this rule made by the FINRA, which stands for the Financial Industry Regulatory Authority. Gather my notes for you guys. And essentially the rule is that you have to have equity account balance of $25,000 or more to have unlimited trades in your account, in your brokerage. So if you have less than $25,000 equity in your account, you're subjected to only 3 day trades within a 5 business day frame. 3 day trades within 5 business days. So basically 3 day trades a week. And now let me tell you, yes, this is protect the investors and the traders and things like that, but day traders, you can't be a scalp trader if your account balance is less than $25,000. You just cannot be a scalp trader because that means you're like placing in trades like on a 5 minute time frame and things like that. You're opening and closing, getting in for quick profits and getting out. You're not going to be able to do that if your account balance is not over $25,000 because once you hit over 3 day trades, which means you open and close a trade within the same day, once you hit more than 3 within a 5 business day period, 2 things can happen. They're going to restrict you from your account and you have to put $25,000 or like have your account balance up to $25,000 in your account, or they're going to restrict you for 90 days and then they're going to give your account back to you. Now that is with the brokerage for IBKR, and every single brokerage in America has the pattern day trading rule. No matter if you're with Webull or Robinhood or Coinbase, no matter whatever you trade on, if you're trading stock options, you're going to be subjected to that PDT rule unless you have a balance over $25,000. Now, if your account is over $25,000, you can trade as much as you want. Like, you can open and close a trade for however much you want. Y'all, I was just over here talking with this strap hanging, like, Lord, we're going to put that in there. All right, now back to business. But no, so that's only if you have a margin account. And we went over that in a previous video where essentially they're loaning you money to be able to trade with. Now, if you have a cash account, you're not subjected to a pattern day trading rule. You could have $10,000 in your account with a cash account and you're not still going to be subjected to a pattern day trading rule. But all that money that you're trading with is your money. So every dime that you're trading with is your money. You can only trade with as much as you have in your account with a cash account. Now, a margin account, which you can also take a margin loan out of, we talked about that in another video. That's when the rules start coming in and things like that. Now, if you've been following me on my trading journey, you know that right now I am currently on restriction for violating the pattern day trading rule. When the interest rates were cut and things like that and the stock market was going crazy, I was just like putting in trades and stuff, getting my profits, and totally forgot about the rule. To be honest, I was just seeing the amount of money that I could make in the market, and I got really excited, especially when the Oracle stock jumped up that 600%. I was like, yeah, put it in, take my profits to another one. It was just, yeah. So I'm on restriction right now. But I did not create this video to tell you what the pattern day trading rule was. No, I created this video to tell you the amendments that they're making to the pattern day trading rule that the FINRA approved last week, and now it's going through the SEC, the Securities Exchange. We made a video talking about that if you're interested. And essentially the amendments they made is that you no longer have to have $25,000 in your account to be able to have day trades. So a trader only being able to do 3 day trades in a given 5 day business day span, it's gone now. And instead they replaced that with your trading account is going to go based off of your maintenance margin that you have. This is for margin accounts. So whatever your maintenance margin is, that's how much you have to have in your account to be able to continue to put in these trades and things like that. You no longer have to have $25,000 in your account to have unlimited trades. Now, if you fall below your margin, that is your fault. Okay, you have to keep track of your trades and the money that you're risking. That is important in trading, is risk management. Now, if you fall below your margin, you're going to get a margin call and they're going to start liquidating your assets to bring you back to good standing with your margin. requirements. Now, the only thing about this, you guys, it's good, but then it's bad because like it's making it easier for you to get money, but then it's also making it easier for you to blow your account, for you to lose a lot of money. So the whole reason that the pattern day trading rule was even put into place was because of the dot-com bubble burst. So now let me teach you about the dot-com bubble. All right, it sounds like it makes me feel like so old talking about the dot-com bubble because it's like, but anyways, the dot-com bubble was essentially when people were like really ecstatic and things like that about the World Wide Web, so www. And essentially it was like investors and businesses were like, oh, we can put our companies on the web so it can be more accessible to clients and customers and things like that. And a lot of people were very optimistic about it, and they were creating these and investing into these online companies and things like that. So for one reason, so that they could have their stuff all over the world seen, but then also on top of that, so they can grab that domain, because like websites can't necessarily have the same domain. So it can't be www.netflix.com and then another www.netflix.com. It can't be two of them. So in order to keep their business name with the .com at the end, a lot of businesses were just kind of like putting themselves out there, and they were looking at the potential future revenue that they could be making and not accessing what was going on actually in the market at that time. And that is kind of where the trouble began. And also the trouble started as well because in the 90s it was low interest rates. The late 90s it was low. We're gonna keep it going. It was low interest rates in the 90s. Okay, the economy was doing pretty good. Okay, so those low interest rates as well was making it easier for people to borrow money to create these online businesses and put them on the web, or be able to just borrow money in general to create businesses and put their products and things on the web and things like that, and to also invest inside of these tech companies in the stock market. Now, pause. Does this sound a little similar to what's going on right now? Lower interest rates, the stock market is overvalued because everybody's investing into these AI stocks. All right. Now, let's go back to what we're talking about. So these tech stocks became extremely overvalued, and the Federal Reserve chairman at the time, Greenspan, came on the news and was like, yo, the stock market is overvalued right now. Like, this is not okay. But of course, everyone's like, traders, we want to make money, blah, 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 blah. Shut up, Greenspan. So that's the same exact thing that they're doing to Jerome Powell. They're like, shut up, Jerome Powell. We want to make money. We don't care about the economy. So that's exactly what's happening right now. So you can see, like, history is literally just repeating itself. So instead of it being technology stocks, it's AI stocks, which AI and technology are like kind of like co-dependent on each other, whatever. So what goes up must come down, you guys. It was hitting all-time highs and things like that, and it had to come crashing down because people realized, oh, like the economy is not doing that great right now, and the stock market is actually overvalued. So the NASDAQ fell by 78%. 78%. And this was mainly because of the technology stocks. Okay, they plummeted, wiping out a whole bunch of businesses. A lot of businesses went bankrupt and just had to get thrown away essentially. And a lot of investors and traders actually lost a shit ton of money because the NASDAQ dropping by 78% is actually insane. So you guys remember in one of my last videos, I was like, there's going to be a stock market crash because the stocks are overvalued, and history always repeats itself because people just can't learn from their mistakes. Literally, it's happening all over again right before our eyes. Like, literally right before our eyes, it's happening. AI and technology stocks right now are completely overvalued. Nvidia, completely overvalued. AMD, like, all these companies are completely overvalued because not everybody, but a lot of investors and traders, they're just so optimistic about the things that AI technology has done and what it can do in the future, but they're not realizing that they're pouring all this money into these stocks that aren't necessarily reciprocating the revenue yet. So yes, these companies are making a lot of money and things like that, but I mean, Nvidia can't even sell their chips in China anymore. But nobody's really like looking at the fact that they can't do that anymore. People are still just overvaluing this stock, and federal chairman Jerome Powell again already said that this was an overvalued stock market, and he was really hesitant on lowering these interest rates. Also, Trump publicly stated that he wants to make the economy crash so that he can rebuild it up to become a better America, to make America great again. Okay, so that's public knowledge. Like, he said this, so this is exactly what he's doing. He's like trying to manipulate the market in ways and ease interest rates and things like that to push us into a recession and to just move forward from there. So it's like you have to be very careful when you're investing inside of these stocks and things like that, because it is going to go down. Don't put your whole life savings in an Nvidia stock, because it's going to go down. My best advice is wait till it goes down, till it hits those real lows, and then invest into it once you see it going up, because it's going to go down, but it's going to come back up. Okay, it's going to come back up. It's Nvidia, it's AI. Like, AI is supercharging the future, so they're going to come back up, but it's going to have a crash before it goes back up. But while that is crashing, while the stock market is crashing, gold is going to be booming. Okay, so take some money, put it in gold. Don't wait for the stock market to crash to put your money in gold. You're going to be paying pretty high prices. Look at the market, see when you can find a good time to enter a good position inside of gold, what you think would works for you and your risk management, and hold it, because this is not going to be for a couple months or something that the recession is going to last. It's going to be for a pretty long time is what I'm projecting. So hold that gold for a pretty long time and watch how much you eat. So now the decision to get rid of the pattern day trading rule and the $25,000 equity minimum amount is in the hands of the SEC, okay? And I'm pretty sure that it's going to be passed, because the reason why the FINRA stated that they even changed this rule in the first place was because a lot of investors and traders and just financial people in the market were complaining about this rule because they said it's outdated. This rule was essentially created to protect investors and traders from something happening again, like the dot-com bubble burst. Okay, so instead of you putting all your money into these stocks and losing money and things like that, they want to protect you from being able to lose all your money, which is what people were doing back then. So they put this there for their protection. But my thing is, you're taking this is my thing though, this is made for traders' protections, right? Yeah, it sucks sometimes, but it's ultimately made for your protection. Now they're taking it out, or they're trying to remove it when investors are going to need the most protection. There's about to be a recession, and like, investors and traders are going to need protection. And they're removing this rule that's meant for their protection. But you know me, I don't like to get too deep inside of that kind of stuff. I like to let y'all do y'all's research, just give y'all a little tidbit for y'all to think about. But you guys, that is all I have today for the pattern day trading rule, and it is in the hands of the SEC, like I said before, and we'll know probably by the end of the year whether this is going to be approved or not, or maybe sooner, who knows. But I will keep you guys updated 100%. Okay, and I just wanted to remind you guys that pretty girls can do stocks too. All right, I will see y'all tomorrow.